This video will discuss managing and reporting revenue using Alert. To effectively manage a service business, there are three distinct KPIs that should be reported and monitored. These are sales, billings and revenue. Alert is a business management system that is able to manage and report these KPIs. Let's consider the definition of each of these KPIs. A sale occurs when a customer commits to the supply of a service or product. Usually, this commitment is confirmed by way of a purchase order being received from the customer. Billings occur when an invoice is raised. Invoices are raised either in advance or arrears or on a basis and timing that has been agreed with the customer. Revenue is determined as the value of services and products provided within a defined period. For services, this can be considered revenue earned for the period. For service organisations, this includes revenue for a period where services may be provided. The service provider may be on standby for a given period, regardless of if they were actually called on or not. In this case, a standby service has still been provided and revenue earned. Let's look at some reports in Alert that report these three KPIs. Firstly, sales. This report is displaying sales by financial period. For example, should the organisation receive a purchase order from a customer for $50,000 worth of services in August, then this would be reported as a $50,000 sale in August, even if the services provided to satisfy that customer order will be provided over the next few months. Now looking at billings. This is one of the easiest KPIs to understand. It is simply the dollar value of invoices that have been invoiced within a financial period. The financial period being determined from the date of each invoice. Revenue is somewhat more complex. For services, revenue is the amount of revenue that has been earned in a financial period. This is important because this revenue is then compared to the direct labour costs associated with providing those services to calculate a gross profit margin. For other non-service items, such as purchased products or miscellaneous items, revenue is the same as the billing amount for the financial period. In Alert, revenue for a financial period is calculated. The best way to describe how Alert performs this calculation is to take a look at the form in Alert that manages the calculation of revenue. This form is the Period Revenue Adjustments form. This form incorporates a number of facilities in Alert that calculates revenue earned. Revenue earned is calculated and categorised as either accrued revenue, being revenue earned but not yet invoiced, and prepaid revenue, being revenue invoiced but not yet earned. The Prepayments and Accruals tab on the Period Revenue Adjustments form contain revenue calculated by Alert for each of these. In this case, for this project, there are no accruals, but there are prepayments. The Revenue and Billings tab on this form is the combination of prepayments and accruals and provides a summary of the revenue amount for each financial period and how it has been calculated. In this case, we have a service provided, an invoice raised in advance for services provided over a set period. Another way of reviewing revenue that has been calculated by Alert is to refer to the Revenue and Margin Detail Report. This report is simply revenue less costs equals gross profit margin for a project and financial period. Revenue, costs, gross margin. This is the end of this part of the discussion on revenue recognition. Please now watch the 2 videos that demonstrate and discuss how Alert manages accrued revenue, being revenue earned but not yet invoiced, and prepaid revenue, being revenue invoiced but not yet earned. Thank you.